Get Rich Slow with John Wolf. Hey, today I'm going to take this discussion back to basics, and that is the basic home loan types. So I want everybody to understand that there are two general type of home loans. So you have either government insured or government regulated. Off to the side, we're going to spend a minute talking about what's called portfolio loans, which you guessed it, are neither government insured nor government regulated. So first, let's go with the government regulated loans. So government regulated loans, it's what people call a conventional. It's what your mom and pop told you to put 20% down on. Now there's a lot more flexibility on that. There is, very good lending options. You can do 3% down, especially as a first-time home buyer, but 5% and all the way up to 25% has the exact same interest rate in almost every single case, except PMI. PMI is the main difference. So if you put less money down, you're going to pay a little bit more for this little monthly insurance that is going to go away. And a lot of times it's going to go away if you refinance just a couple years later. I do it for my clients all the time. But anyways, that's a real thing. So let's go over to the government insured loans. So government insured loans. So we have USDA, VA, and FHA. And I kind of feel like these loans have some personality. USDA loan is the best loan that nobody qualifies for. No, I don't mean really. Some people do qualify for USDA, but I lend in Portland, and it is very difficult to make a USDA loan work in the immediate vicinity of Portland. And I mean like an hour drive from the center of Portland immediate vicinity. Either you're not allowed to do a USDA loan because of the geographic area, or the people make too much money, or the house is too expensive. There's a lot of restrictions to that program. But if you do fit in that mold that they have, that very narrow qualifying window, it is great. It's zero down, and it has arguably very similar fees to VA. It's really good, and VA is one of the best loans out there. So anyways, let's move on to VA. So the personality of the VA loan to me, it's an Old Testament God. The VA loves its people. It wants to do right by them, but it has many rules and absolutely no mercy. If you have walked the shining path and you've done everything right, your VA loan experience is going to be super easy and awesome. And if you've had troubles along the way, the VA loan will give hard no's for a bunch of reasons, and it'll ask for excruciating detail and documentation for a bunch of reasons. However, that being said, lowest interest rates of any loan type, and if you're a disabled veteran, it has the lowest total fees of any loan type. And if you're not a disabled veteran, it just has a single upfront fee that they'll actually roll into the loan for you. Great, great option. Also, the best option available for first-time home buyers buying multifamily, like a fourplex or something. Great option. Now, let's move into FHA. Now, FHA is basically the city cousin of USDA. Now, you're allowed to do it out in the country, but the big difference right off the top between USDA and FHA is FHA has no income cap. You can make $1 million a year and do an FHA loan, and it will let you buy anywhere. So those are the two biggest differences. Now, aside from that, it allows the highest debt to income ratio, which is a double-edged sword. That does mean it's the easiest loan for people to get underwater on as far as their monthly expenses. And then let's just take a little detour and let's talk about portfolio. So portfolio loan is everything that's not government-backed or insured. Now, there are still consumer financial protections for most of these loans, and those are all the ones where you're buying a home for yourself. I'm not talking about what some people call hard money loans when they're trying to do some kind of investment buy and flip operation, but these are like homes for you loans. And the most common of those, they're just called jumbo loans. So almost the same rule as conventionals, except stricter, and the dollar amount, maximum dollar amount goes up. The maximum dollar amount of a normal conventional is a $510,400, at least today, loan. And you have to put at least 3 or 5% down, so the purchase price is higher than that. Same numbers, roughly speaking, for FHA and VA, although they can vary by county, and USDA completely varies by county, but that's kind of the very absolute max amount for that as well. The other types of portfolio loans is there are some credit unions out there who offer zero down programs. These tend to have very strict rules, and many of them actually force you to prove that you have enough money in a bank account called reserves to make, 3 or 6 months of payment, which isn't generally required for the other loan types, but sometimes is. It boggles my mind a little bit, because if you have the money to make 6 payments in advance, you already almost have 3% down and don't need the program. But whatever, it is what it is. And then some of the more common types that don't exist right now, but I'm sure they're going to come back, are what people sometimes call like bank statement loans or investment cash flow loans. And that would be something like, there are contractors who their income according to their taxes is very low, but a lot of that is that their tax accountants very cleverly depreciate and write off all kinds of things. So on paper, it may say that they only profited $30,000 in a year, but they somehow ended up with a new house and a new truck inside of that and a million new tools. So in reality, we know they make a lot of money. So we can do an analysis of, how many dollars went in a month, how many dollars went out of bank accounts, and we'll do that for 1 or 2 years, and we'll calculate a number for what your real income is, and we'll lend based on that. Now, I just want to give people an idea on the super general interest ranges for these different programs, because they have a far bit of difference. So like right now, most of the government regulated loans that I'm doing, the normal conventionals, those are almost all happening between 2.75% and 3.25%. And that's for better credit, not even great credit, but not bad credit. For VA and USDA and FHA, almost all the loans are going for 2.25% to 2.75%, in that range. And again, that's not even for perfect credit, that's just for good to okay credit. And then the last one, the portfolio loans, and these aren't really happening right now because of, nobody wants to buy a less than prime, not government-backed mortgage loan right now. But just before, in March, you were talking about, like 6 to 8% interest loan, maybe 5.5. So that's kind of the range that you should expect for each of these types. So anyways, I'm going to make more detailed notes about each one of these programs. But if you are a first-time home buyer or you are an investor, the 2 directions you're probably going to want to go is, most of the time, if you're not VA, that's a whole nother discussion, is you're going to want to do, if you're just buying a home for yourself and it's the first time, you're going to want to do conventional single-family home. And if you want to kind of take a bigger bite in the investment end, if it's possible, you're going to want to do a duplex, threeplex, fourplex, and it's almost always going to map out to be better to do that FHA. Well, anyways, if you have any questions, please send them to me. I'd love to answer them. Smash that like button. And again, I'm a loan officer in Oregon and Washington, so if you think I can help you out, give me a call. I'd love to try. Have an awesome day. Bye.